So what we are able to do in accounting is to provide for an allowance for this amount. So if you have an accounts receivable balance of $100,000 and a large portion of it is 60 or 90 days old, chances are the accountant and the business owner are going to meet at some point in time and provide for an allowance for what we call bad debt, or for allowance for uncollectible accounts receivable. This allowance is not only recorded on the income statement as an operating expense, but because we want to make sure that everything's in sync, it's also recorded on the balance sheet right under the accounts receivable account in the current assets section of the balance sheet. This transaction and this account, this allowance for bad debt, is called a Contra account, C-O-N-T-R-A. And it's a Contra account because it actually is an account that offsets the other account, in this case accounts receivable, to determine the net realizable value of accounts receivable. So on that balance sheet that you're looking at, that accrual basis balance sheet, and you have accounts receivable, you're going to either see that it's going to say accounts receivable net, or you're going to see right under it allowance for doubtful accounts with an amount in brackets which is being reduced, which reduces the accounts receivable balance. Now, these Contra accounts are common not only in the balance sheet account, but you may also see these Contra accounts as applied to inventory. For instance, when you buy inventory, and this inventory sits, and it is no longer in fashion, it is no longer in fad, and no one wants to buy it, you may see that the owner of the business and the accountants have, again, had a powwow to now reduce the inventory for this inventory that is now no good. Again, this type of allowance is commonly referred to as a Contra account to the inventory account. Okay. Now, one of the ways that we, as analysts of financial statements, and you as observers of financial statements, will look at a financial statement to see if it has any irregularities or defalcations, is to try to compare, again, the transactions or the figures from one period to another. Inventory is an interesting account because inventory has a relationship with not only the income statement, but it also has a relationship on the balance sheet. Let's talk about the relationship inventory has on the income statement. When we discussed before the different components of the income statement, and we said that it starts with revenue, less cost of goods sold, equaling gross profit margin, we didn't really discuss or address how cost of goods sold is computed. So let's look at that now. Cost of goods sold represents the historical cost of goods that have been purchased, held for sale, and are no longer now in the premise, belonging to the business. They've been sold. Let's look at an easy equation. Let's say the business starts this year, so the beginning inventory is 0, and it buys $100 worth of widgets. So purchases equals $100. If you take your opening balance, your opening inventory balance of 0, and you add to it your current year purchases, you get a total of $100, and that $100 represents what we call available for sale. To determine what the cost of goods sold is, we subtract from this available for sale the amount of inventory that is held at the end of the year. This is the same inventory figure that is on the balance sheet. And we subtract this amount to come up with our cost of goods sold. So, if we have $100 worth of purchases, and our available is $100, and we have ending inventory of $40, then our cost of goods sold is our cost of goods is $60. Okay? And we subtract that $60 from our gross revenues to determine our gross profit margin. Now, this may be a little complicated without actually seeing on a board, but I just want to make a couple of simple suggestions for you. Number one, when you're looking at financial statements, compare the common size analysis for inventory from one period to another. In fact, you don't necessarily have to do it just in two periods. When we look at a financial analysis, when we're performing a forensic analysis or some type of analysis for litigation, we frequently look at 5 years because many accountants and economists and business people believe that 5 years produces what we call a normal business cycle. Therefore, we look at more than 1 year to see if there's a tremendous amount of fluctuation within the common size analysis exercise. Now, I had mentioned to you that available for sale was nothing more than the opening balance of accounts of inventory plus the purchases. Well, that's not all entirely true. The cost of goods available for sale should include not only the cost of purchasing that widget, but any cost that is associated with getting that widget up for sale. Maybe the widget needs to be delivered. We have freight. Maybe it has to be modified. Maybe it has to be stored, a warehouse expense. Maybe certain amounts of labor has to be employed to get that widget up to snuff. Now, it's very simple when we're buying a finished product, a widget. But suppose we're making the widgets, and we have to buy elements A and elements B and elements C, and then have labor to melt the elements, and then cool the elements, and put them together, and then finish them, and polish them, and paint them, and tag them, and wrap them. All these costs are associated with the developing of the product for sale. And all those costs go into the cost of goods sold computation. Let's quickly go down the line and talk again now about selling expenses. Selling expenses is really a very common sense category, even if you're not, an accounting geek. Selling expenses commonly include those selling expenses such as commissions and salesman salaries and advertising costs that are associated with getting the product out the door. Whereas general administrative expenses are those expenses that are related to accounting, they could be related to travel, they could be office rent, utilities, telephone, office salaries, all the other, it's a catch-all. Okay? Now, this is really very important because when you look at financial statements, you need to be able to know if all these categories are treated equally from year to year. In many instances, when we look at financial statements from our point of view, we commonly find that there's a misclassification or irregularities, not necessarily in the preparation of the books and records, but in the classification of the categories within the different the elements of the income statement. For instance, in year one, you may see that advertising expense is included in selling and marketing costs. But in year two or year three, you may find that advertising expense is included in general administrative costs. It's very important to have a watchful eye in regards to these things because it enables you to understand how the business is really doing and to be able to compare from year to year. Now, by the way, if I didn't say it before, and I apologize if I'm being redundant, the reason that we look at more than 1 year is to really see the trend of the business and to be able to compare apples to apples. Another exercise to do this is to not only compare the financial results of the business to itself on a year-to-year basis, But we commonly look at this financial information from our subject company to its peers. Now, what are peers? Well, peers are those companies that are in the similar line of business, possibly the same location, of the same size, whether it be asset size or revenue size, and we want to compare them to each other because we want to make sure, again, that there is no material. We want to make sure that there's no material misstatement. Not that we're pretending now to be the auditor, but we want to gain a better understanding of the business. In that light, we use financial statements for another exercise, and that is to do what we call a ratio analysis. A ratio analysis is nothing more than a computational exercise to gain an understanding of how the results of this analysis interpret or have some meaning for the health of the business. Now, we've been constantly talking about the gross profit margin here today, and that's one of many of an analytical or ratio analysis. But there are also things like quick ratio and asset test and other ratios like sales to officers' compensation and debt to equity, things that are really above and beyond our short lecture here, but certainly are part of the exercise you may want to have employed if you're looking at a certain set of financial records. So now we have this financial statement, the balance sheet, the income statement, the footnotes, the multiple schedules, the supplemental schedules, the statement of cash flows, and we have a really terrific understanding of what's going on with the business, good, bad, or indifferent. But now we're saying to ourselves, you know, I'm an attorney, I'm not an accountant, but I'm looking at certain categories and I see discrepancies. How do I go about identifying what these discrepancies are and how we can determine if they're real discrepancies or errors or just changes in classification? Well, remember I told you at the beginning of the lecture that the financial statement is really the end product. It is a culmination of the preparation of books and records that start from a checkbook and go all the way through to various journals, are merged together in what's called the general ledger, and then obviously the general ledger is summarized in what we call a trial balance. And from a trial balance, that's where we form the financial statements. Now, a general ledger is really the book as it applies to the books and records, because each and every transaction recorded by the company, whether it be the cash basis accounting method or the accrual basis accounting method, each transaction is summarized by category within the general ledger. We commonly refer to this as a detailed general ledger because every single transaction is listed. So for instance, if we want to look at the telephone account within a general ledger, we would, if we had only one telephone line, see 12 payments, January, February, March, all the way to December. 12 payments that comprise the total of the figure, the total figure for telephone expense on the income statement. Now, what we want to do is we want to be able to look at these transactions to make, or this activity, to make sure that there aren't a significant amount of problems. Or if we have a question, we want to know why there is an issue. Frequently, we're asked to look at a set of books and records, not necessarily because they think there's a problem, but the figures lend themselves to further investigation.